Next up, we have Paul Engerman from Ainslie Wealth, which is a broker-dealer of bullion out of Brisbane, who also has a ERC20 Ethereum token for gold and silver. But I'll let you explain that. Thanks, Paul.
James. So whilst we're up and running. Thank you, everybody. So I guess my principal reason for being here today is to talk about the rubber hitting the road. So we're a bullion and crypto dealer, so we're seeing firsthand what's happening. I'll talk a bit about that. So just very quickly about who we are. So we're one of Australia's largest bullion dealers and one of the oldest since around 1974. In 2017, we introduced the Big Five crypto as well into the mix and allowed a seamless swap between bullion and crypto and over-the-counter crypto as well. Then in 2019, we launched our own gold and silver tokens, which I'll speak to a bit more. But that's just the context to see where I'm coming from. So in terms of both bullion and crypto, again, these are complementary, not competing assets. And they essentially have three drivers that we see in the store. And that's essentially the protection crowd, the real money crowd, and capital gain. So protection, these are the people that aren't necessarily looking about making money, it's about keeping their money, okay? And that's really about, in this world of all these derivatives and everything else, it's about things that have no counterparty risk. We then talk about real money, and Keith, I think, gave probably the best spiel on real money, or what is money, this morning. And this is really about an alternative to fiat, and be that in saving or transfer. And I guess in the local context too, it's about protecting yourself from the devaluation of our own Aussie dollar. And then I guess the main crowd is capital gain, and that's about making it, not just keeping it. And that really comes down to, I guess, the play of the lack of correlation that we have in these hard assets as opposed to the rest. And also, I guess, the volatility and not being scared of that, but actually embracing it. So again, firmly in the camp of these are complementary, not competing assets. They share much the same properties in terms of their money. I guess gold and silver bring that 5,000 years of history, and with that, for gold in particular, you have market depth, and Alex put up that market cap before. And then you also have utility, okay, in terms of the real use, and that's especially the case for silver. And then you have crypto, which is only 10 years old, and that's very much bringing the volatility play to the table as it finds its price. So if we look at the market depth, you know, and really this is an important thing in terms of where the big money will go when we do have this crash or correction or what that may be. So now people often talk, so there's 190,000 tonne of gold that's ever been mined, worth around $7.5 trillion. But if you look at what's actually available, and if we look at bullion, the estimates are around $3 billion. Now, a lot of that's in central banks, it's in Chinese legacies, etc., so it's not available. So the estimates are that tradable gold is about $1.5 trillion, okay? But that still dwarfs silver, which again has a whole lot more that's been produced. But if you look at what's available in investment form, then you're looking at about $70 billion, so a much, much smaller market. Amusingly, Bitcoin, I wrote this last week, and Bitcoin had a market cap of 150. When I looked at it yesterday, I thought, oh, I'm going to have to revise that down to 133. Well, last night and today, that's jumped to about 176. Such is the volatility of Bitcoin. So, but it's still a relatively small number. And if you look at all the crypto together, again, 225, I think is now 290. But the key thing is, they're all small numbers, okay? If we look at the $300 trillion that's sitting in financial assets around the world, and you add another $200 trillion in private real estate, what happens when that flees for safety, okay? And this chart, I think, tells it all. So in all of, wherever the, anyway, you can see that. So when all of that blue bar tries to get into that little 0.5%, okay? Supply, demand and price neither Bitcoin nor gold nor silver can you just turn on supply. Okay, so when you get all that demand, there's only one variable left, and that's price. So even gold will struggle in a very nice way, price-wise, with that fleet of safety. So if we look at utility, gold, about half of it is used in jewellery, and whilst the industrial use has diminished, it's still 8%, and it's reasonably constant now. But it's relatively small. In silver, you've got over half is used in industry, and these are in industries such as solar panels and electronics and medical equipment, things that are discarded after use. So a lot of it's going into this industrial use, but then it's not even being recovered. And then you have another quarter that's in silverware and jewellery. So there's only a quarter of that silver market that's doesn't have that utility, I guess. In Bitcoin, its utility is in the transactions. There's very little lost, apart from, as we heard last night, that 4 billion, I think, is estimated, 4 million Bitcoin that's estimated to have been lost. But there's no loss in that silver sense. And then you've got Ethereum and the altcoins. So Ethereum, again, a great utility. And we have altcoins, so we've got all manner of utility tokens. Not many of them have worked so far, but there's plenty that have, and they will crack it. So then we talk about volatility, and of course, gold's depth gives it that stability. Okay, so less so, we see silver. So a much more volatile market because it's a much smaller market. And that gold-silver ratio, which I'll talk to more later, for many is a play of that volatility. Now, I'm a paid subscriber to Nugget Service, and I highly recommend anyone do so. If you want to learn more about this space, it's a brilliant source of education. But within that community, there was one guy that had a cousin who was a very senior private equity guy, and he put it to this guy, so here's Bitcoin, tell me what you think. It's the world's worst constructed sentence, but it actually gives, I think, a really good insight into the potential for Bitcoin. So by the way, I read today that the average length of Bitcoin ownership is 89 days. That's very mental. No wonder mad volatility. It's basically a financial asset in its embryonic stages of existence that is conceptually sound, but establishing its fundamentals and credibility. It is subject to wild volatility as it's being used as a highly speculative investment vehicle during this phase by traders seeking to profit from its exaggerated reactions to external events which occur due to a lack of an ability to anchor itself with said fundamentals and credibility while it finds its place on the market landscape. May have moved about 2% just in that sentence, but I think it encapsulates the potential for Bitcoin. This is a private equity guy, very smart guy, that's saying this stuff is real. It's got good fundamentals, but it's going through this discovery phase. So let's talk about the rubber hitting the road, the ground truthing. So if we go through each of those three broad drivers that I spoke about, I'll give examples. So Mr. A, and Mr. A has been a growing phenomenon in 2019. So these are high net worth individuals. This guy had $1.5 million in term deposits, and he was putting it into gold as each of those expired, and very quickly so. So why? Because there's a growing fear of the safety of your money in banks. And that's really coming down to balance sheet exposure, principally to property. We all know that Australian banks are heavily into property. And if we have any real correction in property, then they're illiquid. They're also, and a lot of these guys have been spreading their money around $250,000 in each institution to try and embrace the deposit guarantee scheme. But I think things like the bail-in laws that have come in last year, the cash ban laws, they're starting to read the play that the government is putting in place, I guess, an agenda that will see them keep your money in the bank and potentially take it. And at the end of the day, a deposit guarantee scheme is just a government decree which can be removed. So these aren't gold bugs, these aren't conspiracy theorists, these are high net worth individuals that are just reading a very obvious playbook at the moment. Again, in the protection space, so in the past, protection has been a big play for bonds. And what we're seeing now is, as Alex just put up there, bonds yielding next to nothing, or in other countries, negative. So So all of a sudden, you've got your safe haven asset that was the go-to because it gave you a yield, now not really giving you, and in that risk and reward, I guess, equation, it's not stacking up. So Mr. B actually sold $1.8 million of US Treasuries and corporate bonds, actually. He had some corporate bonds, and put that into gold because he's just looking at the counterparty risk, okay? He wants a safe haven asset, but the counterparty risk just doesn't stack up in the bonds anymore. So still in protection C, Mr. C. Mr. C is a very well-heeled healthcare professional, and he's taken a very dire view of the Australian property market to the point where he's divested all his investment properties, and he's put that into a mix of gold, Bitcoin, Litecoin, our silver standard token, which I'll speak to later, but also his own new high-end property. So his play is really, he says, I just want things that can't be recklessly expanded. So for him, a unique property that has city views, river views, harbour views, whatever it might be, that has a finite supply, he's differentiating from the rest. So he has a very dire view of this, but not on that. Same token, gold, silver, and large cap cryptos he sees as being in the same boat. Now, I put this in there because I didn't know how good Keith's was going to be, but I thought it was an excellent. So this is just something, a very quick run through. So the 7 fundamentals of what constitutes money. So Aristotle, as Keith said, came up with the first 4. Economists have added another 3 over the last 100 years. So if we just go through very quickly, durable, portable, divisible, intrinsic value, again, I'm firmly in the camp. This fiat currency does not have any intrinsic value. Intrinsic value is value in and of itself. Okay, so that $20 note or whatever it is in your pocket is a piece of plastic. So we're talking about no counterparty risk in and of itself. Medium of exchange, again, a couple of us said it today, gold arguably isn't a great medium of exchange. You can't buy a cup of coffee with it or a car. Although there's one gentleman in the room that I know has bought a Land Rover with gold. And we have at Ainslie facilitated property deals with gold, but let's face it, it's rare, okay? And then unit account and fungible. So this can happen anywhere. But let's go through, I'll talk to these in more detail. I cannot talk about money without putting that up. We must all be reminded of the irony of this gentleman quoting that with what they're up to now. So let's talk about money in intrinsic value. And to be honest, we already have, okay? A lot of what I've already spoken about is because that gold and silver and these large cap cryptos have intrinsic value through their scarcity. So let's talk about portability and fungibility. This is an interesting one. So this is about this medium of exchange and portability as well. So Mr. D is a fairly recent customer, US citizen, working in Australia, earning Aussie dollars, wants to buy gold now because he sees it as a good time to do so, but he wants to be able to take that home when he eventually goes back to the US. But he didn't want to carry it there for obvious reasons, and he was hell-bent on avoiding the SWIFT system or similar to sell here and transfer that cash to the US. So the solution was quite neat because we have these different assets that avoid all of that. It was to go into our gold standard token. That was his gold play. At any time, here or there, because crypto doesn't care where you are, he could simply turn that into, he was talking ether, but it could be anything that was convenient at the time, quick and efficient, just by swapping that through Ainslie Wealth. And then in the US, he can just sell that for US dollars. So it's a very neat way of, I guess, buying and diversifying with it, because we see a lot of people that are trying to get, remove sovereign risk from their wealth as well, so they want to hold some of their wealth outside of their country, or you have those expats that want to repatriate. And look, I had a good friend that worked in Zimbabwe, and the efforts he had to go to get his money out of Zimbabwe were phenomenal, to the point where he bought a yacht and sailed it home. That was how he repatriated his money. So if we talk about medium of exchange, look, that's essentially why we established Ainslie Wealth, is so that people could spend their money, whether that money was gold and silver or whether that money was crypto, and vice versa. So it allowed people to swap between these assets seamlessly without hitting any Aussie dollars. We're also a merchant for travel by bit, which which Alex mentioned earlier. So travellers using that travel by bit network of merchants can buy anything from airfares to a Kookaburra coin from Ainslie Bullion, so in their travel. So this is really all about using your money, okay, in its native form without actually having to convert back to fiat. And then we have capital gain trading. So volatility is a fantastic thing if you don't get caught up in emotion and if you have maybe the technical analysis to help you through it as well. So the first example are Brother Z. These guys are uncanny. They bought a very large amount of Bitcoin off us in mid-2017. And then right at the peak of that run in 2017, they sold it all and they put it into silver and gold. It disappeared. And then they came back mid this year, just before Bitcoin started to take off, and they sold all that gold and silver and put it back into Bitcoin. So their timing was canny, but they did all of that without touching an Aussie dollar once. So this is really about allowing you to use the relative volatility of these assets, but actually do so within that hard asset space. The other thing within that volatility is, and I mentioned before, the gold-silver ratio. So the example here is Mr. F, and Mr. F is a really telling ground truthing the ground truth example too, because he's a project home builder in Brisbane, which is where we're based. And what he is seeing is basically, they've been quite busy up until now, but there's just nothing in the pipeline. This guy is getting hammered with calls from tradies every day looking for work because it's just stopped. And he's not alone. I know one of the larger builders in Melbourne, same thing. There's a perception, just like everyone's comfortable, right? Because there's a perception of being busy, but they're finishing 12-month-old contracts. And he too is saying there's just nothing in the pipeline. So we're seeing a very, I think we're about to see a big shift in that Australian property market. So Mr. F is seeing this and he's getting ready. So he's basically selling everything. He's getting all his money out of the bank. So the day his term deposit matures, it's into silver for him because he is also just looking at math, okay? Reversion of the mean. That gold-silver ratio has been a fairly predictable cycle over the years. And so at the moment and we've come off because silver started to take off, but we're up to 94-1. Earlier this year. Okay, now we're down into the 80s, but that's still, nearly twice the sort of 100-year mean of 45. It's more than twice where we were with in 2011, where it hit 30-1. So his clear intention is he's going all silver now, but he says when it gets back down to a low GSR, he's just going to swap that into gold. So he's not talking about taking profit in fiat at that stage. He's talking about putting it into gold, still staying in the space, but just playing that ratio. And you can see, when we talk about that 2009 to 2011 run, silver went up 400% compared to gold, 100 in that time. But the vast majority of people are looking to make money because of what I said before, is these are uncorrelated assets. Okay, so most of the financial assets that are out there are highly correlated. Okay, so everyone talks about having all your eggs in the one basket and then they've got a diversified fund or a balanced fund. But what they don't seem to realise is that all these so-called diversified assets are actually highly correlated. So whilst they have all these baskets of eggs that they think are nice and safe, they're actually all in the same truck. So when the truck crashes, all those baskets go down. So gold and silver and crypto are about getting into another truck, okay? Getting your basket of eggs into something that's not correlated. And by example, this is a table that shows you the worst 5 years on the Australian stock market. And then, so in each year on average, you're down 24%. In the same year, if you're in gold, you're up about 38.5%, so you're 63% better off in those years of being in gold rather than Australian shares. But crashes don't seem to care about calendars, and if you look at the GFC, shares literally halved and gold literally doubled over the period of the GFC. And just to dispel what a lot of the So a lot of financial advisors don't want you going into gold because it doesn't yield, it's not an investment. So to remove that noise, this chart shows you the performance of gold, silver, all Australian houses, the ASX 200, or All Lords I think it is, and cash. But it has compounding interest in a term deposit in cash. It has dividend reinvestment plan in the shares, and has rental yield in the property. So even playing field, we still have gold outperforming the rest. You can see silver, and look, while we're talking about don't know where the thing is, but so you can see quite clearly silver going to that 30-to-1 GSR in 2011, what that plays out like, okay? Reverted back to where gold was as it came back, but that's the play in the GSR. But if we fast forward, that's done every March, so I thought, well, let's have a look what it's like last week. And because we've had this run up in gold and silver this year, now silver's overtaken as well. So silver's starting to do that slingshot that it does. It was off 94, now it's at 80 something as it's slingshotting down to whatever it'll end up at, 30-to-1 or whatever. But that's Bitcoin. And that green line down the bottom is all the other ones you were just looking at. So context is everything, okay? But again, within that context is as everyone's screaming at this big thing, told you it was a bubble, eh? Told you it was going to crash. So it's only gone down to whatever, 700,000% or something. But again, for context, a little company in 1997, before another bubble, the dot-com bubble, started with shares, close to zero, obviously, went up to about $100, and then the dot-com bubble crashed down to around $7. Okay, again, told you this online shopping thing wasn't going to work, told you it was a bubble. That's it down there on your bottom left. So that $7 went on to about $1,100. So when something is fundamentally, online shopping clearly has fundamentals, and it's the same with Bitcoin. So we can get caught up in this volatility and bubbles and that sort of thing, but if the fundamentals are good, I think it's something you just got to look past these gyrations as it finds its value. So a little bit more about who we are. As I said, we've been around for 45 years. In 2016, we started to identify this new asset class, and we saw this has got a lot of the same fundamentals as money. So we looked into it. There was a GST double dip at the time. ScoMo came out and acknowledged this is a currency, so you can't have GST on a currency. The double dip went away, and we hit the market the next day. And at the time, we were the only over-the-counter, human-to-human, lock in a price, then pay provider in Australia. We allowed you to buy on your SMSF in a compliant way. That wallet there, so it's just a paper wallet, but it's produced completely offline on computers that have never been online, printers offline by definition, papers offline. So it was essentially an unhackable cold wallet, and you could walk out of the store with that. So it was hugely popular. We obviously went through that mania in 2017, and then we started to look at, okay, let's try and combine these two worlds, okay, the blockchain and gold, because there's a real opportunity there. That wasn't an easy easy exercise, sorry, because there's regulations to figure out. And this has real costs, okay? This was using real gold and silver that has costs. So how do we recoup that cost without charging people at the purchase? So building in fees to a smart contract and that sort of thing. So we did all that. And we launched it early this year, and it's now available through us, OTC, or on CoinSpot. So it's gold standard and silver standard. Why is it different? We've seen a number of gold and silver, gold-backed cryptos. I think we're one of the only silver around. And look, and as Digic's saying, a lot of these are similar, but they're different in different ways. So how are we different? We're domiciled in high regulatory Australia and geopolitically safe Australia. It's brought to you by a 45-year-old bullion dealer, not a startup, not via an ICO that's just raising money to sell you the same thing. We're not government owned. We're not part of a financial institution. And look, the metal is already held securely in Reserve Vault in Brisbane, deep underground, in a high security vault. It's secured by, it's audited by BDO every quarter in a way that every bar cannot be used as soon as they leave. So every bar, every serial number, every make, where it is in the vault is all noted on a database that's publicly accessible. Very similar to what Digix had it up before, so you can compare the database of every bar by its serial number and its location against the public ledger of Ethereum. It's fully insured by Lloyd's of London. It's fully redeemable, so you can, for free, redeem your tokens for the metal, or you can spend it with Ainslie Wealth and just swap. It's already tradable on an exchange, so it's already on CoinSpot. It's on a really neat a roundup and micro investing app called Bamboo as well, where you can do micro investments or regular investments as well. And critically too, it's different in that you can do very high value over-the-counter trades without moving the market at all. So you can come and say, I want $10 million worth, we just buy $10 million worth of gold, put that in the Reserve Vault, mint it, and give you the token. So you wait a week, but you've got price certainty, and you've just bought $10 million worth of gold without moving the market. So just to wrap things up, I guess the takeaways are, we're very much that crypto and metals are complementary, not competing. They each have their own benefits and advantages and are worth exploring. The gold and silver standard combine these worlds. So you've got that 5,000-year-old monetary asset combined with the transferability, the ease of storage, the security of storage, and the cost effectiveness of blockchain. You can buy 5 cents worth of gold standard at the rate that people pay $5 million for. And so to have a look more about it, you can go to goldsilverstandard.com. But I guess, as I've said, and we've heard time and time again over the last couple of days, we're heading towards something pretty nasty. And I think now's the time to be considering these investments. And I really think you need to do it quickly because you don't want to be too late. There's a good old saying you're better off a year too early than a day too late. And I think that's something that'll come home to roost very shortly. So thank you, everybody. The usual disclaimer. And thank you.
Wonderful.